Hey there, everyone. Welcome to our end of the year live stream. I can't believe the year got away from us again. Happens every year this time. My name is Linda Keith, CPA. I am the founder of Lenders Online Training, where we help lending and credit professionals say yes to good loans. And we've been doing this for over 30 years. I'm joined today by Joe Davis, my colleague and senior credit trainer. And man, he has experience like crazy from front lines all the way through C-suites with commercial or with community and regional banks. So happy to have you here today, Joe.
Great to be here. Thank you, Linda.
So as we prepare for year end, what we know is that some borrowers and their tax advisors might be making a host of year end adjustments to try to reduce their taxes, and rightly so, maybe.
Of course, many CPAs focus on income tax reduction. In fact, some of them actually specialize in income tax reduction. And certainly business owners are eager to reduce the amount of money that they send to Uncle Sam. Now, Linda, as you examine financial statements, where are some areas you would look to see evidence of year-end tax planning?
Well, one of our senior credit trainers, Dave Stoffaker, loves a balance sheet, and I do too. And this is an area where actually a balance sheet can be a good indicator, and here's why. When we have tax returns and are using tax returns primarily for analyzing cash flow and ability to pay debt, often those tax returns are done on a cash basis. But the balance sheet that's on it, if it is 1120, 1120S, 1065, the balance sheet is based on books and records. And if their books are on the accrual basis, now we do have some accrual information that actually can really help us with this specific question. So here's what I look for. I look for changes in prepaid expenses in the asset side, deferred revenue in the liability side. And here's what I mean by that. Prepaid expenses, they've already paid for something, it's for next year. So on accrual basis, it's going to show up next year. Well, cash basis, they are out the money, but in terms of how well did the business do last year, if those prepaids have jumped, then there is a noticeable change. If they are the same, they just wash out. So if this is a business that every year end, they do the very same thing, they buy equipment early or whatever, well, it's going to wash. But if it's changed, then maybe it's not going to wash, and maybe it will make a difference. Now, that's the prepaids. The deferred revenue is where they have received money they haven't earned yet. They've received a deposit. They've received something of that nature. If they've received money they haven't earned yet, again, difference in cash basis versus accrual basis. Deferred revenue is a typical approach to try to push something off for cash basis, but nothing wrong with deferred revenue as long as they do it legitimately. So if I bill out at the end of the year, don't get the money until next year, then totally fine. Goes in next year, and if that's cash basis, I'm happy about that. If I get the money by December 20th and just choose not to deposit it until January 10th, no, not legitimate. So there's a lot of legitimate ways to defer taxes, and then some things that aren't quite as legitimate. And if that flew right by you, we have a full module on cash versus accrual basis that we use in the financial statement and the tax return analysis course. And it really does clarify what is the difference with those and what difference does it make in terms of our understanding of the business. So that's a quick look at the balance sheet. How about the income statement, Joe?
Yeah, Linda, really good points in the balance sheet. And in terms of the income statement, I think many analysts and lenders, they jump right to the bottom line. They're looking first and foremost either at taxable income or net profit. I think it's natural, right? But they need to be really careful with confirmation bias and drawing initial conclusions before doing more analysis. So, if you jump right to that bottom line, you see really thin profits, or you see even a net loss. Gosh, I'm thinking they had a bad year. Call time out, do a little bit more digging. But in terms of year-end adjustments, Linda, I always think about big depreciation write-offs, big depreciation expense right at year-end. That's something I see quite a bit.
Well, and with first year depreciation, that could simply be I'm going to buy a piece of equipment, need it soon anyway. Why don't I buy it by December? Write the whole darn thing off in depreciation. So, one thing, actually, depreciation could be the first topic in many of our discussions because depreciation is non cash. And so, when you're doing the analysis, we typically add back depreciation to see what was going on with their actual cash flow. This does remind me, though, and confirmation bias, absolutely. My husband was a contractor, residential real estate. And so every year we had to go through the process of getting our operating line of credit renewed. And so every year we would provide not only the business tax returns, but the personal as well, because we were personally guaranteeing. And I remember there's this one period of time where he was actually building and keeping these houses as rentals. So we were acquiring rentals. They were all being depreciated as we got them with high depreciation there in the beginning. And this lender looked at our 3 years tax returns. Bottom line is dropping, AGI. And she says, "Ooh, what's going on?" I immediately knew that she didn't actually understand what she was doing, but also she kind of fell prey to what Joe is talking about, that we look at the bottom line, and if you are not careful, you will start drawing conclusions way too soon. That's what confirmation bias is all about. The minute you think they're in trouble, guess what? Everything else that looks bad, you will notice it, and things that actually look good, you won't even ask the right questions to figure it out. So you don't want to embarrass yourself by letting them know you don't know what you're doing, but admittedly, a lot of them wouldn't know. They would just wonder, oh, maybe I am in trouble. The banker thinks I'm in trouble. Oh, no. Let's see. So taking advantage of first year depreciation by accelerating equipment purchases themselves is a tried and true method. And Joe, you've looked at ag lending quite a bit. What do you see your farm clients doing?
Yeah, farmers, like most other business people, often actively seek ways to reduce their income taxes. I saw this pop up in a couple of main ways. First, many of them would prepay next year's operating costs. So things like seed, fertilizer, chemicals. Sometimes they would use excess liquidity, but other times they wanted to draw on their line of credit for that. Now, we as bankers, if you use the existing line of credit, then it's really tough to track the separate years for carryover purposes. So for me, a best practice was always to use a separate line of credit for each year. And then you have a requirement that each line is paid in full by maturity. This makes it really much easier to monitor each crop year and detect any potential issues rather than if you're just throwing all the funds into one pot. And then the other thing that I would see farmers doing is making those big year-end equipment purchases. We joke that farmers fall in love with green metal, right? We would see guys buying John Deeres every couple of years. So they'll request quick funds for capital expenditures. So this increased leverage needs to really be considered and underwritten. You have to balance, optimal lending and your credit policy with what the customer wants, and they're probably in your ear wanting these funds right away. So it's also but a really tough time of year to gauge financial strength, since many farmers, row croppers particularly, they haven't yet completely sold that year's harvest. So you might be operating with incomplete information. And that doesn't even factor in uncertainties caused by tariffs. That's, obviously a big topic this last year. And let me be clear, this is not about politics. That's not my point. It's about planning for the following year and beyond. It's about being aware of what, outside forces may impact financial results. And you may want to, in conversation with the operator, really assess how they're mitigating the risk of uncertainty from really anything, weather, tariffs, commodity prices, et cetera, et cetera. You might learn something really valuable that you can take back to your other borrowers, but you can learn things about either how they're mitigating risk, or maybe they have their head stuck in the sand, which is kind of scary.
Very scary. Well, and this idea of being so interested in replacing your equipment, sometimes I would run across a tax advisor who was actually saying, oh, you know what? You ought to replace that equipment. You'll get first year depreciation. It'll really be good for tax purposes. And I worry about tax advisors who don't actually understand the business implication of the advice that they are getting. So as a lender, if you see them making moves just for tax purposes and there's not really a business reason for it, I would notice that, and I would wonder not only about their business understanding, but maybe whether the tax advisor either doesn't understand or just doesn't know enough about what's going on with that individual business to give them good advice. Now, another area this comes into is in the individual side, when they are taking capital losses to offset their income and maybe move them into a lower tax bracket. Should point out there are different IRS rules for short-term and long-term capital losses. They generally can take a $3,000 net loss each year and then carry over whatever's left, so it'll help them going forward. So when I see a loss, there's really a couple choices. One is they just made a lousy investment in the first place. But they may be timing, and appropriately so. They know they got a big gain. So this is a great time to take a loss on whatever that was that they weren't sure of. So this is a good example. Sometimes we cannot tell just by looking whether someone is making a good decision or they have a problem. And that is why we can't just look, Joe. We've got to talk, right? And listen.
Yeah, indeed. Some digging is required, right? In my career, when I saw clear signs of tax planning by either incurring losses or making those large purchases, it always sent up a red flag for me. I wondered about the borrower's business acumen. So for example, those big year-end capital expenditures that you talked about that I mentioned a little bit, they're going to have lingering impacts due to the new debt they incurred. That new debt is likely requiring payments for several years. So did they really need that new equipment, or was it just for tax planning? So some borrowers can go really overboard with this. It's a really short-sighted strategy. Now, on the other hand, some business owners are very shrewd. They have long-term, well-developed plans for tax reductions. It just depends, but you have to find out.
Well, and you mentioned a red flag, and just one of the things that the learners in our training hear all the time is a red flag doesn't mean a deal killer. A red flag means you ought to notice it. You ought to notice these discrepancies between business choices and tax choices, and then have the conversation, get more information to make a decision, make a judgment, document your judgment so that in your documentation, it's clear that you spotted the red flag, you asked the various questions, and you went ahead and resolved them. And for junior lenders who don't have the judgment yet, your job is to spot the red flag and bring it to the attention of your mentor. Again, is the tax preparer too focused on tax reduction? Are they really understanding the business? Ditto for the owner. So there you have it, year-end accounting adjustments and expenditures that can throw off your financial analysis. Now, note you won't actually see these until after year end. So you might see it in the first financial statements you get for next year, where you actually finally see the year end. If you're going just with tax returns, shoot, you may not really get a chance to use what we just talked about in analysis until April, but you certainly could inform your year-end conversations with your borrowers based on understanding what they are doing here. So enjoy this episode and then come back and listen again when those 2026 returns start coming in. Well, just the tip of the iceberg today, as usual. If you need to better understand tax returns or financial statement analysis and the income statements and balance sheets that come with those, how it impacts year-end moves, cash versus accrual, or if you or someone on your team need that foundational training to make sense of it all, gain confidence in the ability to both analyze and explain, learn to document it, the whole 9 yards, then let's connect. lendersonlinetraining.com/talk is where you can reach out to our team and just find out whether something that we do would help you. That's lendersonlinetraining.com/talk. And as a final reminder, we love to hear your comments, and we use your comments and questions both to determine what our live streams will be, write blog posts, and bring it into our training as well. So contact us there, experts at lendersonlinetraining.com, or sign up for the Ask the Expert series at lendersonlinetraining.com/experts. Ask the experts. All right, guys, thanks for coming. Until next time, have a great day and a great end to your year. Bye.